Since the Industrial Revolution, the U.S. economy has experienced a recession on average every 5 to 7 years. It's a rhythm as predictable as the seasons. Boom, then bust. Growth, then contraction. For over 2 centuries, no expansion has lasted forever. The question isn't if the next downturn will come, but when. And right now, a chorus of economic indicators is humming a familiar, foreboding tune. This is the business cycle, the heartbeat of a market economy. It consists of 4 distinct phases. First, expansion. GDP grows, unemployment falls, and confidence soars. Second, the peak. The economy hits maximum output, often with inflation rising and assets becoming overvalued. Third, contraction or recession. Activity shrinks, jobs are lost, and investment stalls. Finally, the trough, the lowest point from which recovery begins anew. Since 1854, we've documented 34 of these complete cycles. They are the economic equivalent of gravity. What goes up, fueled by optimism and credit, must eventually come down, pulled by excess and reality. At the core of this rhythm is credit, the economy's primary accelerator and brake. During expansions, confidence is high. Banks lend freely, businesses borrow to expand, and consumers take on mortgages and car loans. This credit fuels more spending, which fuels more income, which justifies more credit. It's a virtuous circle, but eventually, lending standards slip. Riskier borrowers get loans. Asset prices, like real estate, inflate based on borrowed money. Then, something cracks, a spike in defaults, a shift in central bank policy. Lenders pull back. The virtuous circle reverses into a vicious one. Less credit leads to less spending, leading to job losses, leading to more defaults. This is the credit cycle, and it's the primary engine behind most modern recessions, from 2008 back to the panic of 1873. Another powerful, often overlooked driver is something called the inventory cycle, or the bullwhip effect. Imagine a small, unexpected dip in consumer demand. A retailer, noticing slightly slower sales, cuts their new orders from a wholesaler. The wholesaler, seeing a 10% drop in orders, panics and cuts their orders from the factory by 20%. The factory, facing a 20% order drop, slashes production by 30% and lays off workers. Those laid-off workers spend less, creating the very demand drop they feared. This amplification of small signals through the supply chain causes violent swings in industrial production and employment. It's a primary reason why manufacturing data is such a sensitive leading indicator for the broader economy. Beneath these shorter cycles ripple much longer waves, driven by technology. Russian economist Nikolai Kondrativ proposed 50 to 60-year supercycles based on technological revolutions. Think about it. The age of steam and railways, the age of steel and electricity, the age of oil and the automobile, and the age of information and telecommunications. Each wave follows a pattern. A breakthrough technology sparks massive investment and a long boom. Eventually, the technology matures. Markets become saturated and returns on investment dwindle, leading to a prolonged period of stagnation until the next cluster of innovations emerges. We may currently be in the later stages of the IT wave, awaiting the next revolution in AI, biotech, or green energy to drive the next long upswing. Economics isn't just math, it's psychology. John Maynard Keynes called it animal spirits, the human emotions of confidence, fear, and herd behavior that drive economic decisions. In a boom, rising asset prices create a wealth effect and a fear of missing out. People buy stocks and houses not because of fundamentals, but because everyone else is, and prices keep going up. This euphoria feeds the bubble. Then a trigger, a bank failure, a geopolitical event, flips the script to fear. The same herd mentality now drives panic selling and austerity, deepening the crash. This psychological cycle ensures that markets overshoot in both directions, turning modest corrections into major busts. Since the Great Depression, governments and central banks have actively tried to tame this cycle. The Federal Reserve lowers interest rates and injects money during contractions to stimulate borrowing. Governments increase spending to create jobs. During booms, they theoretically do the opposite: raise rates and cut spending to cool things down. The goal is the soft landing. But in practice, politics and human nature interfere. It's popular to stimulate and bail out. It's deeply unpopular to raise taxes or cut spending during good times. This asymmetric intervention often smooths recessions in the short term, but can sow the seeds for larger imbalances, like the massive debt and asset bubbles, that make the next downturn more severe. So where are we now in the current cycle? The post-pandemic expansion has been unique, fueled by unprecedented fiscal stimulus and pent-up demand. But as we look toward 2025, classic late-cycle warning signs are flashing. The yield curve, a reliable recession predictor, has been inverted. Corporate debt levels are high. After a long period of tightness, some labor market indicators are softening. The Federal Reserve is attempting the delicate task of fighting inflation by raising rates, which historically has often been the pin that pricks the bubble. While a soft landing is possible, history shows the odds are stacked against permanently escaping the cycle's downward phase. Looking back provides sobering perspective. The average U.S. economic expansion since World War II has lasted about 5 years. The longest on record was the 10-year boom from 2009 to 2020, fueled by zero interest rates and quantitative easing. Before that, the 1990s saw a 10-year expansion. Notice a pattern? The longest booms in recent memory were both followed by significant crisis-induced recessions, the dot-com bust and the global financial crisis. The attempt to prolong the good times often leads to greater excesses. The cycle's duration may change, but its existence appears to be a permanent feature of free market capitalism. The business cycle isn't a flaw to be eradicated. It's a fundamental feature of a dynamic, innovative economy. It represents the process of creative destruction, where outdated businesses and practices are cleared away, making room for new ideas. Understanding this rhythm is our most powerful tool. It tells investors when to be cautious and when to be greedy. It tells businesses when to expand and when to fortify their balance sheets. It tells workers which industries are rising and which are fading. We cannot prevent the winter, but we can learn to read the signs, prepare our shelter, and plant the seeds for the next spring. The cycle will turn. The only question is, will you be its victim or will you understand its rhythm?